What's up, everyone? Welcome to Heresy Financial. My name is Joe Brown, and we got a little bit of a sell-off today in gold, silver, stocks, Bitcoin, and just all across the board. We've got some pretty surprising market action today, and so leading a lot of people to question, obviously, what is happening here. And if you dig into financial news at all, you probably saw that we had a big inflation report come out. We'll dive into the details, and I'm going to explain why that inflation report caused a bit of a sell-off in stocks and assets, and as opposed to where you'd expect something like a big inflation report maybe causing an increase in the price of something that's supposed to be an inflation hedge, like stocks somewhat, and gold and silver and Bitcoin. So we're going to talk about why. Ready? Let's dive in. All right, guys, so if you didn't see already, this report that came out today, it was the largest increase in CPI in 12 years. So big jump in the consumer price index. And this is the measurement of inflation that the government uses, which many people think is understated. And I am one of them. There's a lot of tools built into the way that the CPI is measured that makes it really not accurately reflect the actual, on average, cost of living for most people. There's things built into it to where if something increases in quality by their standards, then that decreases the impact of its price rise in the actual index. And so if a big example that's always used is like a washing machine. If it goes from having analog dials to digital dials, they would say that's an increase in quality. So even if it doubles in price, you're going to not have a doubling in price show up in the CPI from that. So regardless, the CPI itself, even with the built-in ways that it tries to keep that number lower than reality is for most people, the biggest increase in the CPI happened in April in 12 years. So I'm going to throw a chart up here so you can see the this is the consumer price index for all urban consumers in U.S. city average. So you can see here the spikes and declines over the last, I don't know, this is since 1980 or so. And what I want you to notice here, look at the dip that happened from COVID, right at the beginning of 2020. Look at the dip in CPI that happened in 2015, and look at the dip in CPI that happened in like 2009, right? So the great financial crisis 12 years ago, we had a big drop off in inflation. Same thing happened in 2015, and the drop in inflation, this is important, that happened from COVID, was not as severe as the last one in 2015 and was not as severe as the one that happened in the financial crisis 12 years ago, which means that the spike we're seeing now is not simply a reversion to the mean. Because when you look at the spike that happened from the bottom in 2009, yes, that was severe, but the bottom was a lot more severe. And so we're already seeing higher numbers as a result of, what they're claiming is just a bounce back from the bottom, but it wasn't even as big of a drop as we had in 2015. And so that's the first thing to note here is that these effects where we're just kind of rebounding from where we're at like kind of the bottom of COVID does not account for most, or it probably accounts for some of it, but not a lot of it, not nearly all of it. So that's the first thing that's important to recognize here. The second thing that's important to recognize here is it's the inflation's effect on asset prices. So one thing that I said at the beginning of the video is that a lot of people expect that when inflation goes up, that pushes gold up. When inflation goes up, that pushes Bitcoin or silver up, and even stocks and real estate, because these things are hedges against inflation long term. But it's important to remember that markets are discounting mechanisms. Markets anticipate what they think the future will be like and try and make the prices something that is reasonable for what the future expectations are. And here's what I mean by that. If you know for 100% certain that the price of a stock is going to drop tomorrow, what are you going to do today? You're going to sell it today. You're not going to wait until it drops to sell at the future price, which you know will be lower. You're going to sell it today at the higher price. Now, when you get the aggregate of all market participants acting on a stock or gold or Bitcoin or silver or whatever the asset is, you get a consensus on what the market expects in the future. They bring the future expectations into the present price. That's what it means that markets are discounting mechanisms. And so when we see high inflation numbers, the market right now, what the market is saying is that nobody believes the Federal Reserve is being honest. Nobody believes the Fed is going to do what they say they're going to do. What does the Fed say they're going to do? The Fed says they're going to let inflation run hot. They say it doesn't matter if we see significant inflation numbers right now because it's temporary, it's transitory, it'll go away. And so the market is saying, well, that's a lot more inflation than we were expecting. And so now we don't expect you to be able to let inflation run hot. We think that you're going to start to tighten. You're going to make money harder to get. You're going to make interest rates go up, and you're going to lessen your bond buying purchases or potentially even start selling bonds, do quantitative tightening, selling bonds into the market to withdraw money from the system. And if that was to happen in the future, that would cause prices to fall. And so the market, seeing inflation go up and anticipating, hey, this could cause the Federal Reserve to reverse course and try and pull inflation back. The market, trying to anticipate that, says, hey, we're going to sell right now. Now, it's funny because this is all, it's largely short term. These are all largely psychological games, especially trying to anticipate monetary policy. Everything is basically the same trade now, just kind of trying to anticipate what the Federal Reserve is going to do with money, make money cheaper or more expensive relative to everything else. And so in anticipation of that, they're actually pushing prices down, which when asset prices start to fall, that is an element, that is a deflationary element. And so that itself could cause the Fed to say, hey, we can't actually tighten because look at what happens to the market when they're just fearful that we'll tighten, even though we've said we're not. And so this response might push the Fed to be stronger and with more resolve come out with greater rhetoric about being easy with money. And maybe they increase their bond buying purchases. Maybe it takes a couple more days of what happened today. But essentially, the markets trying to anticipate what they think the Fed will do, and then the Fed responds to that. And so personally, I've said it before, I'll say it a million times again. I don't think the Federal Reserve has any room to tighten. I don't think that they can do that without accidentally sparking a kind of like a deflationary death spiral. And so that's the last thing they want. It's like the Federal Reserve's legacy to not ever go anywhere near the Great Depression again. They'd rather have hyperinflation over the Great Depression again. And so deflation is literally their ghost. It is what they want to avoid at all costs. And so I believe that this, personally, this isn't advice. I'm just a guy on YouTube, so take this with a grain of salt. But I don't think that this is something that the Federal Reserve is going to look at and say, hey, yeah, this means we should tighten more. They're going to stick with their rhetoric that this is just transitory inflation. It'll go away, and it'll take a lot more inflation than this in order to cause the Federal Reserve to reverse course. And so, to me, this looks like a buying opportunity for those assets that long-term perform really well in light of inflation. Like, again, stocks, real estate, gold. Real estate, you're not going to be able to buy a dip. It's not a liquid security like stocks and Bitcoin and gold and silver, but essentially, that's what I'm seeing here. And so, again, that's one of the reasons why bonds sold off, which push it. Interest rates have spiked today because if inflation is going up, that means and yields stay the same. That means real yields are actually going down because if you loan $100, get $101 back, but the cost of living increased from $100 to $102 during that same time, you actually lost money. And so, in order to compensate for inflation, lenders don't want to lend at the lower interest rates, and so debt will get sold until it pushes up the interest rate to a point where lenders are willing to buy that debt again, and lenders are willing to lend at that higher interest rate to compensate themselves for the cost of living increase, the loss of purchasing power in those dollars that they're missing out on being able to spend while they're lent out. And so that's the dynamic going on here. And again, to me, it seems like we've got more inflation ahead of us, and the Federal Reserve is going to be more accommodative and allow inflation to run hotter before they do anything to suggest tightening in the future. So that's what I'm seeing today, and hopefully that brings some clarification to what the markets are doing. If you have any questions, let me know. I try and be pretty active in the comments section of these videos, at least for the first 24 hours or so while they're posted until I come out with my the next one. So as always, thanks for watching. I really appreciate you guys. Have a good day.